Welcome back. Today we're talking to Monik Kotecha from Insync Fund Managers. We've spoken to Monik frequently before. He's got two funds with a long track record, good performance, investing in global stocks, mega cap stocks. What Monik describes as secular mega trends. Monik, good afternoon.
Good afternoon, Chris.
Nice to see you again.
Likewise, thank you.
Now, we've talked about the fund. We've covered the fund extensively in the past. There are two versions of the fund, one with protection and one without. But irrespective of that, they've both performed particularly well, not only last year when the market was going up strongly, but more importantly this year when the market has really been pretty average and volatile, big fall from February, March, and then a big rise after that. Tell us about it and what you see coming in the future.
Thanks, Chris. Well, we're obviously delighted with the performance of both funds. They both run identically in terms of our long-only strategy. 16 mega trends, 30 stocks across 16 mega trends. And then one of the funds has an additional feature, which is this downside protection for clients who want to buffer their, whose clients may be looking for a little bit of downside protection during volatile periods. But both funds, nevertheless, have done really, really well. The key thing there is mega trends. And the beauty about investing in mega trends is that they don't tend to be very dependent on the GDP. They're actually very lowly correlated. They keep on powering ahead regardless of what the economic cycle is doing. And I think, clearly what the returns show to the end of 19, when the markets were strong, that because our mega trends are growing well in excess of GDP, the stocks did very well. But again, in 20, when we had a much more volatile period, again, because the growth was still there, even though we had one of the worst recessions in the history, in global history, the companies that we own continue to deliver strong revenues and strong profitability because those mega trends are not tied to GDP. And I think that's a clear feature of what we try and deliver for our investors.
Monik, can you give us an indication of some of these 16 mega trends that you're talking about?
Absolutely, yes. So maybe a really interesting one is one that we've been involved in for a while, and if anything, the trend is accelerating, and this is the food prepared away from home market. Now, the food prepared from home, in terms of value size, has overtook the amount that was spent cooking at home back in the US back in 2012. Okay, so there was more money spent on food prepared away from home for the last few years. The post-COVID or during COVID, that trend is accelerated. So the stock that we own in the portfolio, Domino's Pizza, is a company that we're all familiar with. They were showing single-digit sales growth pre-COVID. That's now gone into high double-digit sales growth. So there's a company that's really benefited. It's again not tied to the GDP cycle, and if anything, COVID has accelerated that trend. And one of the key reasons why Domino's does really, really well, it's two things. One is it continues to offer good value, and if you think about in this post-COVID world where things are becoming a lot more difficult, it provides a great pricing point for investors. But the second big driver is that they've always been digitally enabled. So the cost of delivery has always been embedded into the price of the pizza. So during this COVID, you didn't have to pay more to get that pizza delivered to your home. Now, they are right at the leading edge of engaging with the customer. In fact, they've got a 33,000 square foot facility in Michigan where they've got a bunch of innovative guys who are focused on in new technologies, automation. How do I improve the delivery time? And they're working on autonomous delivery, GPS driver tracking. Okay, they're spending all this money to get the food to the doorstep in a much quicker way, and this is clearly been reflected in the acceleration in sales growth that we've just seen.
And what we're probably going to see out of COVID, is it not, is that some of the trends that have accelerated during COVID, and we're talking over Zoom here, but a lot of people hadn't heard of Zoom maybe 12 months ago, and now it's familiar to people home and office. But this trend, whether it's a mega trend or otherwise, is going to continue post-COVID. Once people have got used to using whether it's new technology or whether it's eating away from home, or eating at home, but prepared away from home food.
Absolutely. I mean, a really interesting anecdote is that MasterCard did a survey across 15 markets, and what they found was that 7 out of 10 customers are now starting to use the online payment system, and stated that they will continue to do so well into the future, and they'll be using 50% less cash. So we know the trend toward online payments was already on a growth path before COVID, and what we've seen just in the month of May, if you look at the like-for-like comparisons according to MasterCard, they saw a 93% increase in the number of customers using online payments to facilitate their transaction. So that trend has accelerated, and we strongly believe that it's now on a much higher growth trajectory. And that's one of the reasons why these types of stocks are actually performing very well today.
Sure. So technology and financial services obviously go together in this day and age. Are there other trends that you're looking at outside that? You mentioned 16. Give us a couple more.
Absolutely. Well, one of the exciting areas at the moment is what's actually happening in pharmaceuticals. That's a sector that's generally been out of favor for a period of time, partly because of concerns around drug pricing in the US. But if you look at the last 12 months, for example, the FDA has approved 48 new drugs for unmet needs. So that is at a record high. And a particular segment of the market that's particularly attractive to us within that space is the cancer market. Now, cancer is one of the leading killers, not far behind heart disease, which is an unfortunate thing. It's part of the aging problem. And within cancer, there's a specific therapy that's now starting to be developed called immuno-oncology. So this is now using your own human's home immune system to fight off this disease. And there's a batch of new drugs that are coming to the market, and we believe that that is clearly a mega trend. Unfortunately, cancer is a mega trend. It's part of an aging issue. But what we're really excited is that there's companies that we've found in that healthcare space that trade on really attractive multiples. Everyone keeps talking about the market being expensive. We're actually finding good value within these mega trends. And we believe that market is going to grow at double digit over the next 5 to 10 years. And we've found some tremendous companies to leverage on those trends.
So some people have said that these companies are expensive, but they're growing rapidly. So based on a forward earnings of 1 or 2 or 3 years, they're probably quite reasonable. They grow into their earnings and grow into their price, do they not?
I think that's a really good question, Chris. I think there's a real focus on short-term valuations, and two things have happened. One is that the pace of some of these trends have actually accelerated, and that hasn't been fully being grasped by the market and reflected in earnings numbers. The second is that a lot of these trends are very durable and enduring. So if you only look at the next 2 years of earnings, what you're missing out is what we call the sustainable earnings growth beyond that period. And that's what we spend a lot of time trying to understand within all of our mega trends. If we can get convinced that these are actually sustainable mega trends, and we get a lot of data to try and corroborate that, and then find intensely profitable businesses to leverage on those mega trends, then they're actually, as you quite rightly said, are actually attractive on a long-term basis.
So are you involved in the sort of technical sector where things like Apple and Google, the FANGs, is that part of the portfolio, or have you left that bit alone? No.
I mean, the great thing is these companies are at the vanguard of what's happening today. So as you're moving, you talked about cloud, for example, and Microsoft is clear leader in cloud, and the cloud spend is accelerating. And in fact, if you look at all the business surveys where they ask CFOs, how much they're going to spend on technology and digital transformation, clearly that had to increase because of what's happened. As all of us are now having to communicate with our customers digitally and transacting digitally, then companies have to spend a lot more money to ensure that they have the right technology to engage and grow their customer base. So Microsoft is in the sweet spot. And again, when you look at the longer term sustainable growth rate, it's very attractive. Apple is another very attractive company. A lot of investors look at it as a product-oriented company, but we think it's just a tremendous ecosystem where they're always bringing out products that customers actually love to buy. And the next leg of growth there is clearly 5G, with what's going to happen around augmented reality and virtual reality, and that's really the next step in terms of shopping experiences. And over time, they're going to increase their penetration in that very large and important healthcare sector. So yes, we do own those companies. Just because they're large and have done well doesn't mean that they're not still undervalued, provided you believe, as we do, that the sustainable growth is there. So technology is an important component, and it has to be, because we now live in a technology-driven world. But as the examples I provided earlier, there's a good, rich diversity of trends we're exposed to outside of technology as well, Chris.
Monik, looking further ahead, are you prepared to sort of say what other trends you are looking at but perhaps haven't invested in, or is that part of the secret sauce?
Look, clearly it is part of the secret sauce. We've recently, I can give one example today, but I'm not going to give you the company we're invested in for the time being. But we're on the precipice of 5G taking off in a very significant way. And we recently bought a new company in the portfolio that we believe is the most strongly positioned company to benefit from the 5G megatrend. So now the important thing about megatrends from our perspective is you don't want to get in too early, because when you get in too early, we don't quite have enough information to understand the potential size, the growth, and whether we can actually find good businesses that can leverage on that trend. So you could have got involved in 5G 4 or 5 years ago, but really there was very little clarity in terms of the future. Looking at it today, we strongly believe that the growth rate in 5G is set to accelerate. And we've found a very profitable company with a very strong balance sheet that not only bought back its shares during the COVID, increased its dividend, and is now about to benefit very significantly from the expenditure that's going to take place in 5G.
Monik, we'll look forward with great interest and anticipation in hearing the name of that company, and hope that it continues with your excellent performance going forward. Thank you for your time this afternoon.
Thank you, Chris.